Okay, so today we're going to talk about, is money real or is money really there? You might hear some people saying things like, well, we're spending more money than we have, or something along those lines, and I'm going to kind of show you one way of how we might be doing that. But let's say we have a small town of people with $1,000 total in it. So this could be anyone in the town, but there's $1,000 total in the town. So the people with the money go ahead and they deposit the money into their bank. So now it's showing that they have $1,000 in their bank accounts. So these people in their savings account have $1,000. Now, banks in the U.S. are required to keep an amount of cash on hand compared to how much they have in total in their savings or other investments through them, which is known as the Federal Reserve Ratio, or the required reserve ratio set by the Federal Reserve. It usually hovers around 10%. And what this means is that banks only have to hold 10% of their total savings on hand at one time for their customers to withdraw, and they can actually loan out the other 90%. So customers deposit $1,000 into their savings account, and the bank loans out 900 of those dollars back to people in the town who they deem worthy of the loan. So this could be business owners or anyone actually that is worthy of a loan. So let's just say they give it to some business owners in the same town. Those business owners take that same $900 and they go spend it in the town however they deem worthy, so to help their business or do whatever they want with it. But the point of the matter is it gets spent back in the town. And now other people, let's say grocery store managers, gasoline store managers, anywhere, have the $900. And they are free to go deposit that same $900 into their bank. So let's call that Bank B. So now they have $900 in their savings account, which this bank can loan out 90% of. So it's free to loan out $810 into the same city. The fact is that it's going to get lent back into the town, spent in the town, and then back into another bank and spent the same way. So if you're starting to see a little flaw in this plan, our original investors have $1,000 in their bank, their savings account, and our recipients of the business owner's loan have $900 in their savings account. And when the bank repeats this pattern, we're going to have even more money in people's savings account that's not really there. Now you might be wondering, why would we do something like this? Well, it's actually to stimulate the economy. So the genius behind all of this is that the original investors might not have done anything with their $1,000, but because of the reserve ratio, banks are free to loan the money out to business owners who will stimulate the economy, and America grows and prospers faster and faster. The downside is if everyone tries to take out their money at one time, that's when you see a recession or a depression or bank runs. And there's a few ways to stop those type of things. Banks can even shut their doors and not withdraw or not let their customers withdraw any money. But for the most part, this entire system works just because everyone keeps their money in the banks at one time and doesn't withdraw it. I hope that kind of helps you understand why a lot of people think that money is not really there, or we might be spending more money than we have, because we actually are. Anyway, if you liked the video, leave something in the comments, and as always, please subscribe.